So we're with Eli Smith with ReadyCap, one of our partners for financing for multifamily. And um, so I think we'll just spend some time talking about Freddie, Fannie, Freddie Mac, Fannie Mae today, just trying to get an idea of like what is it, how does it work, how do loans get done, et cetera. So thanks, Eli. Appreciate you coming on, and just maybe you could start off a little bit about what is even, Freddie Mac and Fannie Mae? I mean, what does that even mean?
Sure. So thank you guys for having me today. I appreciate it. Freddie and Fannie are what we would call agency lending. And really what that is that they were chartered years and years and years ago with establishing um, liquidity in the market so that people could continue to do housing, and they moved into multifamily at a certain point. And their mission is to provide affordable housing to folks all across the country. So in that mission, they take on the ability to fund properties that would be considered workforce housing. So in there, they also are driving through that workforce housing, both for multifamily, which has to do with markets, and they look at counties and things like that. So so from a Fannie and Freddie perspective, really when you're jumping in, you're required to go through their seller servicers. They've designated specific groups. We're one of those groups that has a designation to be able to provide those products to them. And so we act as sort of the gatekeeper for those agencies, and we're providing them with the deals. They buy them from us after we originate, much like a single family transaction. So
it's like table funded essentially then.
In essence, I mean, it is. We are funding it. We do hold some of the risk on top, for the deals that we're sending through, and then we retain servicing, and we're servicing them. But yes, in essence, within 30 to 45 days, they are buying those from us, and then we're servicing them for them.
Got it. And then what is the distinction between Fannie Mae versus Freddie Mac? What's the difference, if any?
That's a good question. Really, Fannie was the original, and they started, like years and years ago. And then I think really they brought Freddie in. There's not a huge designation. They brought Freddie in as more of a competition to Fannie because they didn't want there to be any kind of antitrust or, them to overriding, be the only person providing this. So they brought Freddie in, and while they all sort of report through the FHFA now, because of the '09 downturn, there is still a separation of both of those groups. And so Freddie will compete against Fannie and Fannie against Freddie to pick up those deals and go through. So there is some competition. And then even just internally, there's like a friendly competition between Freddie and Fannie, based on the deals that they're looking for and what they're wanting. So I guess another distinction too is, Fannie set up their underwriting to be delegated. And so you'll see the DUS, which is the delegated underwriting service, that they have their seller servicers actually underwriting and making decisions. They will go to them at times for approvals up front, but in most cases, they're making the decision, they're closing, and then Fannie is approving when they're buying the loan. The difference is Freddie likes to have control, and they're actually approving with us. So we don't have any delegated ability to approve a loan. When we we put a package together, submit it to Freddie Mac, and then it takes them 2 weeks to review our package, which has been fully baked, and they make a decision, offer a commitment based on their review, and that's how we go. So there is a little bit of a process difference between Freddie and Fannie. Fannie's been doing it a long time, and this is something that they put in a while back with the delegated underwriting. Freddie likes to maintain the control, so there's a little bit of a difference in their credit culture as well.
Got it. And then what did they, so like what sort of asset types would you say fall into both of those that you guys would look at financing? Obviously,
Good question. So, so they are looking for stabilized multifamily, 5 units or more. They can look at mixed use as well, and they have different requirements, but generally they're looking for the commercial income and or a commercial square footage to be under 40% of the entire property. So as long as it meets those designations, we can consider it. Now, in a COVID environment, which is what we're experiencing today, the commercial aspect of it has changed a little bit. While they will still allow it, they are restricting what income they will allow. It's a case-by-case basis. If you can show and prove that the commercial tenant is an essential business, somebody that stayed open during the pandemic, has still continued to provide services, we can make the case and they will include that income. But in most cases, if it's a restaurant, you know, or like a nail salon or barbershop or something like that, generally those are spaces that could have been shut down during COVID and, you know, maybe struggling to make their rent payment. So again, the mixed use is sort of a carve out that is case by case and definitely something to run through us with. But you know, the multifamily aspect, you know, they really want the stabilized. They don't have any type of bridge aspect to it where, you know, they provide future funding. They really want it coming in with a 90% occupancy for at least 90 days. You know, and that stability gives them the comfort to be able to fund on those types of properties. So, you know, it's really specific to just apartment housing in both cases.
So like so apartments, maybe single family subdivisions that are built for rent, mobile home parks would qualify, would you say?
Sure. So there's also designations within Freddie and Fannie. You have what we specialize in is the small balance, and that is anything 7.5 million and below down to $1 million.
Okay.
And then anything over 7.5 million would go to what would be considered conventional. Conventional will handle those larger loans, but inside of conventional, they also have a group that specifically deals with mobile home parks, senior living locations. They'll also do student housing. So there is some designations within those in the conventional space. Now, if you roll back into the small balance, which is what we specialize in, that case, you know, there are restrictions on student housing. You know, you have to be below 25% concentration on students, and generally we're looking for that to be undergrad. If you have graduate students, again, on a case-by-case basis, we can have conversations about that, see if we can get, you know, a workaround there. You know, military concentration and there's a couple of other concentrations that we would want to look at. You know, maybe if there's a large company next door that most of their workers are there, you know, those are risks that we have to look at and manage. But the mobile home parks are not something that Small Balance does. There's a product type out there called Cardinal Housing. It's generally an older version, and that's something that they shy away from. You know, but you know, you may be able to get something like that done in a conventional versus. So you know, inside of Freddie, Fannie, there are designations, even that which silo the properties, by size and asset type, even in the multifamily. So, you got to look out for those traps.
Yeah, that's great. Thank you. And so then what's sort of the structure of a particular loan? So what would that look like in terms of the terms, the LTVs and prepays and all those fees, et cetera? What's sort of the structure?
Sure. So again, my specialty is really the small balance program. So I'll speak mostly to that.
Yep.
What they're doing is any 5 units or more, 1 to 7.5 million. There are some designations that you have to pay attention to over 6 million as far as property size. And then you have some difference in reporting requirements and a few other things, but we can dig into that at another time. Outside of that, they're really an acquisition rate and term refinance. But I think where Freddie really shines is the cash out refinance. For years past, we've done a lot of cash outs for people in the program, and it's been very successful. COVID has obviously changed a little bit of that. It's still, we're still finding success with the cash out. There are some additional restrictions and credit overlays, but that's definitely something we can work through, and I'll touch on that in a second. So outside of that, it is a non-recourse program. It has the standard carve-outs, which is always a great seller for folks that are looking for that. They have 5, 7, and 10-year fixed products. And then they have a 20-year product, which is split into a 5, 15, 7, 13, and 10, 10. And it's an adjustable rate that goes from a fixed product and rolls into an adjustable for a full 20-year term. The benefit for the Freddie small balance as well is that not only do they have a yield maintenance, but they also offer step down and even a few friendlier step down products. So even for like a 5-year, you can pay up for it, but you can get a 3-1-0-0-0 step down prepay, which is pretty attractive if you have short-term plans for the property. You could take advantage of the non-recourse, a low rate, and have that quick turnaround for the prepayment to get out, within a year or two. So that's something that not everyone, conventional doesn't offer a step down. Fannie Mae doesn't has a step down, but it's not nearly as attractive. And so that's a little bit of the difference. From a leverage standpoint, Freddie Mac also takes their markets and splits them into what they consider top, standard, small, and very small. A top market would be Chicago. They just converted Dallas, Miami, New York, Los Angeles. Even like Seattle would be considered a top market because they're really looking at certain apartment metrics, occupancy, cap rates to qualify those. If you're looking at like a Phoenix, Arizona, Sacramento, cities outside, larger cities but not top markets, those would be considered standard, like a Columbus, Ohio, or Indianapolis. And those metrics are a little bit different. And then as you get further out, they're really looking to designate small versus very small. And that's something that we can take a look at and provide guidance to you guys after the deals you're looking at. Inside those different markets, standard and top markets, we can get up to 80% loan to value on purchases. And in the small and very small, we can do 75% loan to value on purchases. If you're looking at rate and term refinances, we can be pretty aggressive and get to some of those. But there's a lot of caveats with whether it's rate and term or cash out. But for most transactions, we're looking at a lot of cash out, which is designated as anything that's over 3% of cash back to the borrower after closing costs, and on the settlement statement. So with that, they've put credit overlays into cash out refinances. So they're asking for 5% on the loan to value and 10 basis points on the debt service reserve. So in a top market, you're at a 120 debt service reserve requirement. If you're doing a cash out, that moves to a 130 from a 120. If you're in a standard market, it's a 125, moves to 135. So there's some changes there, small and very small. I think you're probably 65% loan to value and a 150 cover on a very small market. So again, the cash out, they want to sort of pull back a little bit, be a little more conservative during these times, and that's something that we have to look for. But another good positive for this one is it is a 30-year amortization. That is a standard feature. If folks want to do a shorter amortization, they can go down to 25 or 20, but it's not recommended when you're looking at the debt service coverage aspects of that. And I think with most people trying to cash out, you want that 30-year amortization to be able to increase your proceeds. Outside of that, we don't charge a point or any type of fees up front. That's generally something you guys will charge. So origination fees are par, and then we can work with you guys on pricing, which we're seeing in a top market for low leverage, like a very, very conservative deal. I mean, we've gotten into the very low threes on some deals. I think average, you're going to see 3.5 to 4%, and a very few deals are going to eke over 4%, and that's generally with something like a very friendly open prepay structure. So you pay for the prepay structures. Another good feature too to think about is offering interest only. Interest only is a programmatic aspect that is offered in the product. It's 4 basis points for every year of interest only, and they have specific requirements for 5, 7, and 10. So you can do usually 1 year and a 5, 2 years of interest only and a 7, or 3 years of interest only and a 10-year. And you can do any combination within there as long as you pay for the basis points for that interest only. One of the things that I've really liked to do because of COVID, they're requiring right now escrow impounds for taxes and insurance, but they're also requiring a 12-month debt service reserve for the borrowers to hold, for any given transaction. So a lot of times I like to trade interest only in for the borrower on that first year and price it in and say, look, we're going to keep your payment low, but we're going to have to collect this up front. And so sometimes that trade makes the sell a little bit softer to understand that, your payment will go down, but you still have to put a full principal and interest away. Any questions on that? Because I can move into some of the other aspects of like the COVID reserve.
Yeah, so that was good stuff. So how do you underwrite a deal with respect to, so it comes in, obviously I know, we got the 120 DCR, you're at 130 and possibly 150 depending on the market. How are you sort of generating cash flow? What's your general model of, this is how we get to cash flow on our side?
Yeah, great question. So, basic documentation that we're looking for up front is our current rent roll. And we'd like the rent roll to be as complete as possible. Understanding bedrooms is a piece of, our underwriting review. So knowing the bedroom count and unit mix is important, square footage. rents, if it's occupied or not. Those are all important. And then we're looking for a good historical. Generally, a T12 is preferred. It's not always provided, which we understand up front, but T12 gives us a good opportunity to see occupancy history over the last, 3-6 months to see how the property's been performing, and then just your standard expenses coming in. So when we get a deal in, a lot of times we're running the rent roll. There's a affordability test tool that we have access to through Freddie and Fannie that we'll plug a rent roll into, and they're looking at those to see what their rent levels are. So if they qualify for what's called uncapped rents, there's a discount that they qualify for. And then if their rents are really low in comparison to the county that they're in and the average median income, they can qualify for an additional 10 basis point discount for very low income or VLI. So the rent roll is important. We plug that in. We look at the expenses. Depending on the market, our standard vacancy that we use after we annualize the rent roll is 5%. And we can make adjustments to that based on historicals, market trends and things like that. So we may tick it up to maybe 6.5 or an 8% vacancy. Or if the historicals show that it's been consistently running at a 90% occupancy, we may put in a 10% and just sort of match up to historically how it's run to see where it shakes out. Other income is something that it can be considered laundry, vending, if there's parking income, pet income. We're looking at the consistent history of those incomes to see if they've been collected. And so we'll make an assessment of that and include that other income, which can help your NOI as well. As far as expenses are concerned, we will do some research on taxes. We're looking at probably increasing insurance by maybe 10% from historical, and use that as a figure. And then really for everything else, it's sort of a 3% annual increase of the expenses. We'll look at management fees, payroll, general administrative, and then one of the requirements for Freddie, which again has been is another good selling point for the Freddie small balance, is that they will underwrite replacement reserves, but they don't necessarily collect the replacement reserves. So something to keep in mind is that if it is under 50 units, then they will not require a replacement reserve. But during COVID, what they have done is over 50 units, they do require a replacement reserve to be collected with your monthly payment. So, that's a change, and that's an adjustment that a lot of borrowers have had to make who have been in this program for years, and then all of a sudden, they're required to have this replacement reserve draw. And so they're having to make the adjustment. But that is generally $250 a unit. It's sort of a standard fee that we will underwrite to, and then we just look at the NOI and the rate, and we're trying to hit that debt service reserve in the market that the property's in to make sure we're there. So there's some general stuff. Freddie provides us with a sort of comp expense spreadsheet, and they take all of the deals that they've done over time and provide that data back to us so we can see where comps in the market are. Sometimes they're good, sometimes they're bad, sometimes they hurt, sometimes they help. So we'll definitely take a look at those too, when we're making adjustments, but we try to provide you guys with a quote, give you the NOI that we're coming to with the income. And then that's between us to sort of come to an agreement and make sure that we're on the same page as far as how we're going to underwrite it in the end.
That's great. Thanks for that. And so replacement reserves is this idea of, because, there's general maintenance, et cetera, then you're going to have this little section after you get to your net operating income where you're going to tack off $250 per door. So if there's, 100 doors, then that's going to be, basically 25, thousand or whatever that's going to get on there. And then that's going to be deducted off of your net operating income in order to get to net cash flow, which is, that's what you're using to, basically service whatever the debt is.
Correct.
Yeah. Okay. And then, so the process is, we bring a package to you, all those items, the rent roll, the trailing 12, the P&Ls for a couple of years, probably some color photos, some basic, demographics about the property, unit mix, et cetera. And
Sponsorship is important as well. So
good.
personal financial statement and a schedule of real estate really have a lot of information that we use.
Because what are you needing to know about the sponsor that's really sort of critical for you to give a thumbs up?
Sure. So some of the requirements that they have for sponsorship is your net worth has to be equal to the loan amount. And then your liquidity has to equal at least 9 months of debt service. So we're looking at their liquidity and their net worth to make sure that they qualify. This program does offer the ability for foreign nationals to be able to finance properties. And the requirements for a foreign national might be revealed on their PFS. And then we're looking for 2 times net worth and 2 times liquidity requirements for those guys. So it's important for us to see all of those items. I think the other thing that Freddie just came out with that we're looking for a little more closely is experience and ownership. So one of the things that they said was, for them to consider somebody to be experienced, if they have only owned one property, and that's the property that we're refinancing, they would like for them to have owned it for at least 5 years for them to feel like they're experienced and have a good knowledge base of that property, the market, and how to manage that space. If they have multiple properties, they're looking for their oldest one to be at least 3 years old, that they've managed multiples over the last 3 years. And that really comes back to Freddie wanting to make sure that they're comfortable, that the person that's there understands what they're up against when managing a multifamily property. Whether it's third-party managed or self-managed, those are important items that they want to know. If they're self-managing and they've only owned it for a year, there's concerns if they understand all of the true challenges that could be up against them. But in the same sense, if they have a third-party manager and they're out of state, that's the question comes back to how experienced are they in understanding the P&Ls that their third-party managers providing them, and are they tuned in to any fraud that might be going on or skimming of funds or anything like that. So management's important, and then ownership, experience, length of time, how many properties and units that they truly own. So that's sort of the basic overview of sponsorship.
That's great. So the package gets brought to you, and then you guys are going to do your underwriting. What's sort of process-wise, 3-4 days, you're able to turn around, sort of give a high-level quote on what it is that can be offered. If there's a green light, then do you go to like a sort of a deep dive to get an actual application out? Is that typically the first tranche?
Sure. When you guys get me the initial package, we're having our analysts really dive in and put that information together. I think we should have a quote back to you within 24 to 48 hours. For you to look at and go back to the sponsor to see if it's something that they want to move to the next level. If that's the case, we generally will give a list of additional details or information that we may need, to gather that documentation to put out a letter of interest. And the letter of interest really can take another 24 to 48 hours. It depends also if there's exceptions that we have to go back to Freddie to, that is one timing thing that comes up more than any other, is that we have to go back to Freddie Mac with an exception request, and we have to provide a lot of detail for them to review and make a call. So sometimes we're held up being able to issue an LOI waiting for a decision from Freddie Mac. And they can come back and they can approve, they can decline, or they can approve with specific requirements and metrics. And so we'll match that and issue an LOI based on that. So our timing, generally 24 to 48 for initial quote, and then another 24 to 48 for an LOI.
So the LOI comes out, it's a couple, 6, 7, 8 pages long. That explains all the terms, conditions, and then borrower's going to sign it. What kind of fees are involved with these types of loan? What could be expected?
Sure. So the borrower is going to sign the letter of interest, and we're going to ask that their good faith deposit be wired in. That good faith deposit, that's something we can work with you guys on as far as amount. Generally, we like to be 10 to 12,000 for a good faith deposit. We can get a little skinnier if we need to in a competitive situation. If we're in a market where there's a bank or Chase or somebody that's, doing really low cost up front, if that's important to the sponsor, we can work with that. So definitely keep us in the loop. But, those fees are used towards the third parties, which would be an appraisal, property condition report, and then lender's legal. So we have to have specific legal counsel representing us for the loan, and Freddie Mac for loan documents. And we've negotiated pricing with them to keep them in that $7,000 range, plus or minus depending on the firm. And that's a flat fee. So, in the end, the sponsor will do the deposit to get everything started and rolling. But then at closing, depending on how we structured it, because we can do capped fees or we can do, a full fee back to the sponsor. And we will, generally they're going to be spending anywhere from 14 to 15,000 in third-party costs and a couple of additional settlement. And then they're required to cover any title and settlement costs, settlement being prepaid interest, insurance and tax escrows, and things like that.
And then once they sign, send in the deposit, you're in the process of, preparing to go get a commitment letter at that point? Or are you ordering third-party reports at the same time, or what's sort of the
Sure.
general process?
So once we receive the wire and the signed LOI, and the signed LOI is really the term sheet. We're looking for credit authorization so we can pull credit reports, make sure they're credit worthy. There's environmental questionnaires and property questionnaires, and those we're sending to the third-party groups for the engineer and the appraiser to have information on the property. While we're engaging those, we're also reaching out to you from a transaction manager who works for me that will send you all the due diligence list and backup documentation. Another great feature of the Freddie Mac small balance is that they actually are a coupon rate. So when we issue a rate, it is not an index over a spread, so it's not going to move around a whole lot. But the other beauty of it is when you sign that letter of interest, we actually lock that rate in for 35 business days. So that's a full 7 weeks that rate is locked. And so whether it goes up or down, that's what the sponsor will get. So, during that 7 weeks, we're expecting third parties to take anywhere from 2 to 3 weeks. And in that 2 to 3 week period, we're looking for all the due diligence to be completed and turned in. And that's You know, like there's a couple of Freddie forms for the borrower and sponsor to provide. We're also looking for some property information and a few other documents. And then once all of that's gathered, we send it to our credit team within Ready Capital, and they have a week to prepare the credit package, and then we submit it to Freddie. So as long as we submit a full package to Freddie Mac within that 7-week period, the rate lock stands true. And then Freddie will honor that rate through their review and their closing process until the end. So it's been really great for a lot of folks to have that, especially in the volatile times. We just don't know whether rates are going up or down. So once we send that off, it's really in Freddie's hands, and they have 2 weeks. You know, that usually they're looking at 10 days to review, and they will go through, ask their questions, get clarification, and then they will issue a commitment letter that we will then provide to the borrower to sign off on. And then we can close within 3 to 5 days after the borrower signed that commitment letter. So another great feature for Ready Capital, and you know, I can't speak for everyone. I know there are some that do and some that don't, but you know, a great feature for us is that when we have the commitment letter signed, you know, that is something that we're not requiring any type of a rate lock fee. So Freddie actually hedges the rate, but at the end, they'll lock it in before they close. And so there are some firms that will require a point to be sent in and held, and then they'll refund it to the borrower. But who really wants to send in $20,000 or $30,000 to be held for a couple of weeks and then get it back? So, you know, we have never really ever required that. And so that's a good feature for your borrowers to know that they don't have to put up a rate lock fee. They are responsible if they break the rate lock, and they have to pay a 2-point penalty. But you know, we still haven't had that happen today.
That's great. And so is it safe to assume that it's going to take 45 to 60 days, start to finish, to close the loan then?
Yep, that's the general timeline that we're looking at. You know, it really comes down to the sponsor and their ability to get the due diligence completed in time, and have everything ready to go.
Okay, great. And last question, is the loan assumable? So if somebody sells the property, somebody could take over their position, or?
It is, absolutely. So this, the loan is assumable. It's a 1% assumption fee,
Okay.
you know, for the guy coming in, and then obviously whatever the closing costs are through servicing, you know, updating title, under legal, things like that. But yeah, it's definitely assumable, and you know, it's a great option, especially in these times when we're, you know, 3.25%, 3.5% rates.
Yeah.
It's pretty attractive in a couple of years to be able to say, you know, why don't you just take this over?
That's great. And then final question, and then we'll land the plane a little bit. Do you guys have any kind of little, you know, financial model that we could be plugging stuff in before we send it to you to just get a sense, or anything like that we could look at?
Yeah, so there is the we do have a sizer that I can provide if you guys are looking for something like that to be able to plug numbers into and see how that works. And then I know we're also in the works with the Intercapital Group to provide you guys with the pricing ranger as well, so that you guys will have the ability to price, you know, from your desks and not have to call me every time. Yeah. So definitely, for sure, we can get that to you guys.
Okay. Well, Eli, we really appreciate you taking the time, and this was really helpful. And I know we'll be reaching out to you for new opportunities for sure. So
absolutely.
Yeah.
Thank you.
Thanks, Dave. Appreciate it, guys.
All right. Take care.
All right.
Bye-bye.